Assalamualaikum and hi everyone, especially to my lecturer Puan Jawaria and all my friends. Today I will talk about historical cost. Historical cost refers to the original cost of an asset when it was acquired or the cost of a transaction at the time it occurred. It is used in accounting to record the value of assets and liabilities based on their actual purchase or acquisition cost, providing a reliable and verifiable measure for financial reporting. Next, we go to prudence. Prudence in accounting refers to the conservative approach of anticipating and recognizing potential losses or liabilities even they haven't yet occurred. It involves a degree of caution to ensure that financial statements provide a realistic and prudent representation of a company's financial position. This principle helps in preventing the overstatement of assets or income and ensures a more conservative estimation of uncertainty. Thirdly is consistency. Consistency in accounting refers to the practice of using the same accounting principles and methods consistently over time. It ensures that financial statements are comparable and that users can analyze a company's performance and financial position accurately. Maintaining consistency helps in establishing reliable frames, making it easier for stakeholders to assess changes in the company's financial condition and performance over different reporting periods. Number 4, matching. Matching in accounting is the principle that detects the matching of expenses with the revenues they help generate. This means that costs incurred in earning revenue should be recognized in the same accounting period as the revenue to which they rotate. By doing so, financial statements reflect a more accurate portrayal of a company's profitability by aligning expenses with the revenues they contribute to, facilitating better analysis of the overall financial performance. Last but not least, accrual. Accrual in accounting refers to the recognition of revenues and expenses when they are earned or incurred regardless of when the actual cash is received or paid. This contrasts with cash accounting, where transactions are recorded only when cash changes hands. Accrual accounting provides a more accurate depiction of a company's financial position and performance by reflecting economic activities in the period in which they occurred, offering a more comprehensive view of the entity financial health. So this is my last point, which is materiality. Materiality in accounting refers to the significance or importance of an item, transaction, or information in financial statements. An item is considered material if its omission or misstatement could influence the decisions of financial statement users. Accountants use the materiality concept to determine what information to include or exclude, aiming to focus on items that are relevant and significant enough to impact the overall understanding of a company's financial position and performance. Thank you. Transaction or information in financial statements. An item is considered material if its omission or misstatement could influence the decisions of financial statement users. Accountants use the materiality concept to determine what information to include or exclude, aiming to focus on items that are relevant and significant enough to impact the overall understanding of a company's financial position and performance. Thank you.
Let's go together. So the next one is going concern. Going concern concept describes those accountants prepare financial statements on the assumption that a business may continue its operations for the foreseeable future. Under this concept, the definition of a foreseeable future is a period of 12 months from the end date of the reporting period. If a business owner or the management investor in scaling down business operation to zero, they cannot apply the going concern. They can apply the going concern concept for accounting. So the term objectivity is used to describe the way financial information is presented in the records and financial statements. It stresses the importance of providing accurate and credible information that is free from certain bias and extrinsic influences. Objectivity guarantees that the financial reporting accurately reflects a company's true financial position, increasing transparency and building trust with investors, creditors, and regulators. The objectivity concept ensures that accounting and financial reporting adhere to objectivity principle. The money measurement is an accounting concept based on assumption and stipulates that companies record only those transactions that they can quantify and measure in terms of money. If they cannot assign a monetary value to a transaction, they don't record it in their annual financial statement. If this transaction affect the company's financial performance, they may not find a place in financial statements as monetizing them can be challenging. This business entity, the business entity, economic entity, or separate entity concept assumes that a business is independent of its own. A business may not record its own personal expenses. A business may not record its own personal expenses, income, liabilities, and assets. Aid in tracking a business expenses. Income and tax deductions without any ambiguity. In addition, safeguards the business owner's personal finances and helps with their credit worthiness. It reflects cash flow and financial position more accurately. One is periodicity. Periodicity is an accounting subject where the accountant so that the company complex and ongoing activities can be divided up into annual, quarterly, and monthly amounts that we report. There will be reports on the respective financial statements. Periodicity allows companies to report meaningful financial statements covering relatively short period of time. Periodicity is also known as the time period assumption.
Hello, have a good day. Now I will continue the second question. All business activities must be supported with document as evidence of the business activity conducted. Different source documents are used for different kinds of business activities. Cooperate and participate within your group members to prepare at least 7 examples of source documents with the function of the documents. For the first example is receipt of payments. The function for this source of document is declares the payment for goods or service has been received, communicates that the payment has been cleared and received without issues. The receipt gives both parties insurance that the financial transaction was complete without any errors or outstanding issues by proving that the money was transferred correctly. Record of transaction. Its service has a formal record that indicates the fulfillment of financial deal. For example, important information is recorded on the receipt, included the date of payment, the amount paid, the mode of payment, and any applicable reference number or invoice. Contributes the positivity consumer relations. Providing a professional and accurate payment receipt improves land satisfaction. Customers can feel comfortable that their payments has been received and handled appropriately, which promotes goodwill and trust. For is bank statement. The function for this source of document is to create entrance in the accounting records. All financial transactions relating to a business bank account are recorded in bank statements. The bank statements keep track of each deposit, withdrawal, check that is written, electronic transfer, and other transactions. Accurate record keeping and the tracking of financial operation depend on this through documentation. Proof of transaction. For example, verifiable and official records of checks written, money received, and other financial transactions are available through bank statements. For financial reporting and audit, this paperwork is incidental. Monitoring account balances. This enables companies to regularly verify the balances of their accounts. Bank statements assist companies manage their available financial by proving details about the beginning and ending balances. Third example is checks. The function for this source of document is gives approval for money to be transferred from the pay's bank account to the pay. The check service as an officially request for payment to the bank. It includes the name of the pay, the amount payable, and the transaction date. Suppose documentation for the tax purpose. The order to claim tax deductions, business expenditures must be verified by checks. In order, prepare correct financial reports for the tax compliance. The information on checks is helpful. And last example is purchase invoice. The function for this source of document is verification of goods or service receipt. This confirms that the products or service has been delivered to the company as agreed. Businesses use the data on the purchase invoice to make sure that supplies or service are made according to the terms that we are agreed upon. It helps in making sure that right things in the amounts were supplied. Create a record of the business financial transaction. The purpose invoice documents to the specifics of the purchase, such as the date, the description of the goods or services, the quantity, the unit pricing, and the total amount. It acts as proof of the financial transaction. Helps in the recording of account payable. The purchase invoice, which shows the amount due to the supplier, starts the account payable producer. This is necessary for controlling the company debates and providing accurate financial reporting. Thank you.
Example number 5, sales record. The information you have on your customers, including but not limited to their contact information, how often they purchase from you, what they purchase, and how they pay their bills. Your company's sales records are quite likely to prove your most valuable marketing information. And then financial statement. Critical documents that provide a snapshot of company's financial performance and position. They are typically prepared at the end of a preparing period, such as quarterly or annually, and are essential for various stakeholders, including investors, creditors, regulators, and management.